Hey everyone, I'm Jane, and in this video, we are going to go over different retirement or financial accounts. This is not meant to be an all-inclusive, every single detail included, but this is to be a general overview. Because if you ever felt overwhelmed by all the seemingly different financial products out there, then you never really take a step forward to learn about them because it just seems like there's so much. But I hope that this video will give you a foundation to kind of build upon, because when people start talking about products, you're actually going to know what they're referring to, right? And there's going to be a little something fun at the end, and it's going to tell you how to remember if something's a bull market or a bear market. So maybe you have heard of a 401k, 403b, 457, TSP, IRA, traditional IRA, SEP IRA, and the list kind of just goes on. And if you've ever listened to this numerical alphabetical soup and just wondered, I have no idea what all of these mean, or maybe I know what one of these things means, well, would you be surprised to learn that they all basically mean the same thing? They are all tax deferred accounts. And again, I might be oversimplifying a little bit, but not that much, okay? They all have different names because of where they originated from. So a 401k, you started at your job. A 403b, you started at a job that was probably a hospital or a school. 457 was a job that was state or local government. TSP is federal government. And an IRA is maybe your job didn't offer a retirement plan, so you walked into a bank or you went online and you opened up an IRA, which stands for Individual Retirement Account. And at some point, whenever you leave all these jobs with these 401ks and these straggler 403bs, then you roll it out and they all become an IRA. So the first time I learned that all of these accounts were the same thing, I literally had like a mind blown moment. Because really there was this part of me that just thought, why don't you call them all the same thing? But I guess where they originated from can be important. But again, they are all tax deferred accounts. That doesn't mean tax never, it means tax deferred. So you got to take a tax deduction today and you're deferring or you're delaying your taxes for later. So I have an example for you. So let's say that you make $100,000 a year. That's a nice round number, right? And you take $5,000 and you put it into an IRA or a 401k or any of these tax deferred products that you have available to you. Then that means that the IRS is going to look at your income like you actually made $95,000 because you got to deduct the $5,000 from your $100,000. So that's why you didn't pay any taxes on that $5,000 right now. So you are deferring taxes in a tax deferred account. The general rule is you cannot touch the money until you're 59 and a half unless you are willing to pay a penalty. Well, whether you're willing to pay it or not, right? The IRS is going to make you pay it if you touch the money before 59 and a half. There are some exceptions to this rule, like if you use the money to buy your first home, then you don't have to pay the penalty. But no matter what, you still have to pay the taxes because it's going to be taxed as regular income when you pull out the money. So you have to pay state and federal if you have to pay state taxes where you are. I've had some clients who they thought that if they waited till they're 65, they don't have to pay any taxes. But that is not the case. At some point in these tax deferred accounts, either when you withdraw it or when your kids inherit it and they withdraw it, someone's gonna have to pay the taxes. You cannot avoid it. So let's say over the course of 20 years, you put $5,000 a year away, and so you contributed $100,000 into your IRA, and it grew to $250,000, right? So now when you take out, let's say you take out $10,000, now that you've retired and you don't have to pay the penalty because you're over 59 and a half. So instead of getting $10,000, you're probably gonna get more like $7,000, depending on your state and federal taxes. But that is how an IRA or any tax deferred account is going to work. Now we have tax tax-free accounts. So primarily, we're going to talk about a Roth IRA or a Roth 401k in this video for tax-free. There is such a thing as municipal bonds, and that is when you give the state money, they issue you a bond, right? And they used to be really good, like the interest rates. But if you Google it right now, I think the national average is like 1.4 for a 10-year municipal bond, which is honestly kind of sad, right? So the rates are not that good. And then there's HSAs. Those are health savings accounts, but you have to have a specific high deductible health insurance policy in order to have the HSA, and they have to be used for medical purposes. So, I mean, that's the gist of municipal bonds and HSAs. So a Roth 401k is something your job offers. It could be a Roth 403b, a Roth TSP, you get it, right? Like that all means the same thing. It's tax-free accounts. All right, and so that means if we take the same guy, $100,000, and he contributes $5,000 to his Roth IRA, then the government is still going to tax him like he made $100,000. There's no tax deduction for him to take. So he's going to pay the taxes now. So that way, if we use, again, the same example, you've contributed $5,000 a year into your Roth IRA over the course of 20 years. You've contributed $100,000. Let's say it grew to $250,000. Now, when you take out $10,000, you're actually going to get $10,000 because you already paid the taxes, and it is in this special account called a Roth IRA. So you don't have to pay any taxes on any of the growth. Still the same, you can't really touch it till you're 59 and a half. Again, there are some nuances and exceptions, like after 5 years, you can take out some of what you contributed, but this video is not meant to be about nuances and exceptions. This is meant to be a general video. So the last type of account, or the last type of money that we're going to talk about, is called non-qualified funds, non-qualified money. So these are your paycheck dollars, okay? This is after, they give you your paycheck. This is your money that gets deposited in your account. You have paid taxes on it, but it's not in a special retirement account like a Roth. So if you have a TD Ameritrade or a Robinhood or a Webull account, right, and you decided to invest in the stock market, if you put $1,000 in and you earned $500, then you have to pay taxes on the $500, not the original $1,000, because you've already paid taxes on the $1,000. That's considered non-qualified money. Another example of non-qualified money would be like a CD. A CD is called a certificate of deposit. You can go to a bank and you could put $50,000 into a CD for 2 years. And let's say that $50,000 you earn $500, because that's probably what you'll earn with a CD now. Now, when you receive that money back after the 2 years, then you have to pay taxes on the $500, but not on the original $50,000 because you already paid taxes on that. So those are what non-qualified funds are. So IRA, Roth IRA, non-qualified funds account, all of those you can gain and lose money depending on where you have your money allocated, right? Like how risky or if it's in the market or not. An annuity is not a separate account, okay? An annuity, so if you have an IRA and you roll it into an insurance company, it is now an IRA annuity. If you have a Roth IRA and you roll it into an insurance company, it is now a Roth IRA annuity. An annuity doesn't change what the original package, like what originally the tax implications are. It's like if I put on a jacket, right? I'm still me. I just have a different shell on, I heard an example of if you had an orange and you put it in a fruit bowl, is it still an orange? And this is not a trick question. So yes, it is still an orange. It just happens to be in a fruit bowl. So if I have an IRA and I roll it to an insurance company, is it still an IRA? Yes, it just happens to be with an insurance company now. When I first learned that I wasn't learning a whole new product, but it was just like a shell that I could put around an existing product and it didn't change the original, that was also kind of a mind-blowing thing for me too. because this is not stuff that we're taught in school. So I just kind of picked up little pieces of information from random people, and some of it was true and some of it wasn't. So that kind of helped me put like the bigger pieces. I hope what I'm going over with you is kind of like when you put together a puzzle. I did a lot of those, being very socially awkward. You could do puzzles by yourself, right? Once you have the border of the puzzle down, then it was a lot easier to fill in the inside. So I hope that this video kind of gives you that border of the puzzle, so it'll help you fill in the details as you continue on your financial journey. I'm going on an adventure! So last little bit, fun bit that we will end with is a bull market and a bear market. If you've watched any type of news clip, I'm sure about the stock market, you've probably heard someone reference a bull market and a bear market. A bull market is when the market's doing good and it's going up, and a bear market is when the market's not doing so good and it's going down. But how do you remember? So a bull is, if you imagine like the horns, when it attacks, it's going up. So that's the bull market going up. And a bear mauls when he mauls you, right? I mean, I hope you don't get mauled, but when a bear mauls something, the claws are going down. And so a bear market is going down. So I hope that helps you remember, and we'll see you in another video. Thank you so much for joining us. Okay, no, that's not this example. Okay.